Hey friends, welcome back to Accounting Core. My name is Yama and in this video, I'm gonna explain the basics of accounting. I'll tell you a story about David who has recently started a new business and show you how we keep track of his business transactions. But before we dive into the story, let's familiarize ourselves with some fundamental accounting terms and concepts to ensure we understand everything better. I've also included timestamps in the video description below so you can easily navigate to different topics of the video as you like. Now, without further ado, let's get started. The main purpose of accounting is to record and track financial transactions. This is done so that businesses can understand how much money they are making, how much money they are spending, and what their overall financial position is. So, accounting is a necessary tool as it helps businesses make informed decisions based on their financial data. Now, here's how we define accounting. Accounting is the systematic process of recording, classifying, summarizing, and interpreting the financial transactions of an entity. Accounting is also known as the language of business, as it communicates the financial performance and financial health of a company to all interested parties. The main goal of accounting is to provide accurate, reliable, and timely financial information about a company's economic activities to its various stakeholders, such as business owners, investors, creditors, and regulators. An accounting system provides financial information in the form of financial statements. Generally, there are 4 financial statements that a company is required to prepare: income statement, balance sheet, statement of cash flows, and the statement of changes in equity. These financial statements provide information about a business's performance, financial position, and cash flows. I will explain how we prepare these financial statements later in this video, but for now, let's continue with the basics. So, an income statement presents a company's financial performance by displaying its revenues and expenses over a specific period, typically a month, a quarter, or a year. This financial statement helps stakeholders to understand how well the company is doing and where its money is going. A balance sheet is like a financial health check of a company. It presents a snapshot of a company's financial situation at a specific point in time. It presents what a company owns, what it owes to suppliers and creditors, and what it owes to the owners or shareholders of the company. A statement of cash flows provides information about how a company generates and uses its cash. It shows a company's cash inflow and outflow over a specific period, typically a month, a quarter, or a year. The inflows and outflows of cash are categorized into 3 sections inside the statement of cash flows: operating activities, investing activities, and financing activities. By the way, if you find this video helpful, please hit the like button to show your appreciation. Thanks for doing that, and let's keep going with the video. A statement of changes in equity provides information on how the company's equity account has changed due to owner's withdrawal, capital investment, and net income or net loss. If you have noticed, there are 5 core accounts that go into these financial statements, and they are assets, liabilities, equity, revenue, and expenses. Understanding of these 5 accounts is very important, as they are the building blocks of financial accounting. Each accounting transaction, whether it's a sale of products, payment for expenses, or purchase of assets, falls into one or more of these 5 accounts. When you understand these accounts, you can easily process and record accounting transactions and can easily prepare and analyze financial statements. So let's quickly define each of those accounts to understand them better. Assets are resources that an entity owns or controls and are expected to provide future economic benefits. Assets are generally classified into 2 broad groups: current assets and non-current assets. Current assets are those that are expected to be converted into cash or consumed in less than a year. Examples of current assets include cash, accounts receivable, and inventory. Accounts receivable represents the amount of money that a company is entitled to receive from its customers for the products or services that it has provided, but for which the company has not yet received payment. Non-current assets are those that are expected to be held for more than 1 year and are not intended for sale in the normal course of business. Examples of non-current assets include property, plant, and equipment. Liabilities are obligations that an entity owes to others and are expected to be settled in the future. Liabilities are generally classified into two broad groups: current liabilities and non-current liabilities. Current liabilities, which are also known as short-term liabilities, are those that are expected to be settled within 1 year. Examples of current liabilities include accounts payable, wages payable, and taxes payable. Accounts payable represent the money that the company owes to its suppliers or vendors for goods or services that have been purchased on credit. Non-current liabilities, which are also known as long-term liabilities, are those that are expected to be settled in more than 1 year. Examples include long-term loans and borrowings, pension liabilities, and lease liabilities. Equity represents the owner's share in a company's assets after all liabilities have been paid. For a sole proprietorship, think of the owner's equity account as the owner's personal investment in the business. But that's not all. The owner's withdrawals in the company's profit or loss also play a part in shaping the owner's equity. Similarly, if a business is structured as a corporation, it may issue common stock to shareholders in exchange for their investment. Common stock represents the ownership interest of shareholders in a corporation. Revenues represents the entity's income from its operations, such as sales or service revenue. Expenses represent costs that the entity incurs in generating revenues. Examples include salaries, wages, utilities, and rent. Apart from the 5 main accounts, it's important to be aware of the gains and losses from non-operating activities. These gains or losses come from activities that are not directly related to the company's day-to-day operations, like selling assets, trading investment securities, or handling interest income and expenses. The gains and losses from these activities are reported in the non-operating section of the income statement. Now, let's understand the separate entity concept before we dive into the story of David. The separate entity concept states that a business is considered a distinct and separate entity from its owners. This means that the financial transactions of the business must be recorded and reported separately from the personal transactions of its owners. For example, if a company gets a loan from a bank, the loan is recorded as the company's liability, not the owner's liability. And when a company makes money, it's counted as income for the company, not for the owners. So the separate entity concept is essential for maintaining accurate and reliable financial records, as it helps to avoid mixing personal and business financial information. The separate entity concept lays the foundation for understanding the accounting equation. The accounting equation, which is assets equal liabilities plus equity, is a fundamental principle in accounting that highlights the relationship between a company's assets, liabilities, and equity. This equation serves as the basis for the double entry bookkeeping system and helps ensure that a company's financial records are accurate and balanced. The reason why assets equal liabilities plus equity is rooted in the basic concept of how a company's financial resources are obtained. A company can acquire assets by using either borrowed money or owners' invested money or a combination of both. To put this in simple words, everything that a company owns comes from borrowed money from creditors and invested money from owners. Now, let's illustrate the accounting equation through an example. Let's say Alex starts a new business and puts $7,000 of his own money into his business's bank account. He also borrows $3,000 from the bank. Now, his business has $10,000 in the bank. The accounting equation for this $10,000 deposit looks like this. Assets of $10,000 is equal to liabilities of $3,000 plus equity of $7,000. So remember this, the accounting equation is always in balance. If one side of the equation changes, the other side must also change to maintain the balance. Now, let me explain the basics of accounting by telling you the story of David. Together, we will prepare a set of financial statements for his company from start to finish, so stay with me. David has a passion for cooking and loves making delicious burgers. He wants to turn his passion into a profitable business and open a burger restaurant. He was looking for a place to rent for a long time and finally found one. On January 1st, he signed a rental agreement and agreed to pay $750 as a monthly rent at the end of each month. David has also completed all the necessary legal paperwork to open his restaurant, like obtaining a business license and a food service permit. He has also given his business the name of David Burgers. Now, to start his business operation, David needs to invest some money to purchase equipment, buy ingredients, and pay for other expenses. So on January 1st, he opened a bank account for his business and deposited $80,000 of his personal savings into his business's bank account. Here is what the balance sheet of David Burgers on January 1st would look like after posting the owner's initial investment. Cash in bank is equal to $80,000, liabilities is equal to 0, and owner's equity is equal to $80,000. David thought he needed $85,000 for equipment, but $80,000 was not enough. So on January 2nd, he got a $20,000 loan from his local bank and put it right into his business's bank account. Here is what the balance sheet of David Burgers on January 2nd would look like after posting the loan amount from the bank. Cash in bank is equal to $100,000. Loan payable is equal to $20,000 and owner's equity is equal to $80,000. As you can see, both sides of the balance sheet are in balance. Now that David Burgers has a place to do business and some cash to spend, David can purchase equipment and buy ingredients to start making burgers. So on January 3rd, he paid $85,000 and purchased all the necessary equipment to make burgers. On the same day, he also paid $3,000 to Restaurant Depot, his trusted supplier, and bought ingredients for the whole month. Here is what David Burgers' balance sheet would look like on January 3rd. Cash in bank is equal to $12,000. Inventory of ingredients is equal to $3,000. Equipment is equal to $85,000. Loan payable is equal to $20,000. And owner's equity is equal to $80,000. As you can see, both sides of the balance sheet are in balance again, as it should be. With $3,000 spent on ingredients, David can make 3,000 burgers. So it would cost him $1 to make a burger. David decided to sell each burger for $5, which is considered a fair deal in the neighborhood where he operates his business. On January 4th, David hired a worker for $100 per day to help him with all parts of his business. The worker gets paid at the end of each month and started working on January 4th. David now needs to keep track of all his business transactions. To do this, he started using a POS system to process card payments and generate sales reports when needed. He also keeps a manual record of every expense transactions in a physical notebook. With the placement of equipment in the accounting system, David Burgers is now ready to serve its customers effective from January 5th. Imagine that 27 days have passed since the time the business served its first customer. It's now January 31st and David Burgers is completely sold out. The owner wants to know whether his company made a profit or loss. He found that David Burgers sold 3,000 burgers, all for cash, and generated $15,000 in sales revenue and paid a total of $3,050 for the following expenses. Here is how those income and expenses are reflected in the income statement. Sales revenue is equal to $15,000. This came from sales of 3,000 burgers at the selling price of $5. Cost of goods sold is equal to $3,000. This came from cost of 3,000 burgers at the rate of $1 per burger. By deducting cost of goods sold from the revenue, we get a gross profit of $12,000. Now, we need to deduct operating expenses to reach net income or net loss. The total operating expenses is equal to $3,050. By deducting $3,050 from gross profit of $12,000, we get a net income of $8,950. When the owner of David Burgers saw a net profit of $8,950, he got excited. He immediately withdrew $1,650 for his personal use. So here is how we prepare the statement of changes in owner's equity. Owner's equity at the beginning of the period is equal to 0. If you remember, David Burgers was established on January 1st, so there was no prior equity balance to report here. Owner's capital contribution is equal to $80,000. This came from initial capital investment of $80,000 by David on January 1st. Next, we need to add the net income of $8,950 to increase the owner's equity account. Then, we need to subtract the owner's withdrawal of $1,650. As a result, we get an owner's equity ending balance of $87,300. Now, let's update the balance sheet to make the accounts in balance. First thing first, let's change the date of the balance sheet to January 31st. Cash in bank is equal to $22,300. This came from the $12,000 ending balance of cash in bank on January 3rd, which becomes the opening balance for January 31st, plus $15,000 cash deposits from cash sales, minus $3,050 for operating expenses, and minus $1,650 for cash withdrawals by the owner. The inventory balance remains zero, as all the ingredients have been used to make burgers. The equipment account remains unchanged at $85,000. By adding all these accounts, we get a total assets of $107,300. In the liabilities section of the balance sheet, the loan payable amount remains unchanged at $20,000. Next, we need to update the owner's equity account to $87,300. This came from the ending balance presented in the statement of changes in equity statement. So, by adding liabilities and equity accounts together, we get a total equity plus liability amount of $107,300. As we can see, David Berger's total assets is equal to total liabilities plus equity. Since David Berger's ran out of ingredients, David went to his trusted supplier and bought $5,000 worth of ingredients on credit. Now, here's how this is reflected in the balance sheet of David Berger's. Cash in bank is equal to $22,300. No changes here because the ingredients were purchased on credit. Inventory of ingredients is now equal to $5,000, not zero. The amount for the equipment account remains unaffected at $85,000. By adding all these, the amount of total assets increased from $107,300 to $112,300. In the liabilities plus equity section of the balance sheet, the loan payable and equity amounts remain unchanged at $20,000 and $87,300. While the accounts payable account with total amount of $5,000 needs to be added to reflect the purchase of ingredients on credit. So, by adding the liabilities and equity accounts together, we get a total liabilities plus equity amount of $112,300. Now, let's prepare the statement of cash flows for David Berger's using the direct method. I will explain the difference between the direct and indirect preparation of the statement of cash flows in another video. But for now, let's use the direct method as we have cash receipts and cash payment information available. So here's the statement of cash flows for David Berger's for the month of January using the direct method. Cash receipts from customers for sales of burgers is equal to $15,000. Cash payments to suppliers for ingredients is equal to $3,000. Note that the $5,000 worth of ingredients that was purchased on credit will not be reported here, as it was a non-cash transaction. Further note that the figures in brackets represent negative amounts. Next, cash payments for operating expenses is equal to $3,050. The net cash flows from operating activities is equal to $8,950. Cash payment for purchase of equipment is equal to $85,000. Apart from the purchase of equipment, David Berger's had nothing else to show as investing activities. So the net cash flows from investing activities is equal to $85,000. David Berger's had the following three transactions to show in financing activities. Owner's initial capital investment in the business is equal to $80,000. Cash receipt from the bank as a loan is equal to $20,000. And owner's withdrawal is equal to $1,650. So the net cash flows from financing activities is equal to $98,350. Therefore, the net increase in cash is equal to $22,300. And this came from adding the net cash flows from operating activities, investing activities, and financing activities. The beginning cash balance is equal to 0, as David Burgers had no business bank account prior to January 1st. By adding the beginning balance with the net increase in cash of $22,300, we get an ending cash balance of $22,300. If this figure is the same as the cash balance shown in the balance sheet, then apparently your statement of cash flows is prepared correctly. As you can see, the statement of cash flows shows the changes in the cash and cash equivalents of the business during the period, categorizing them into cash flows from operating activities, investing activities, and financing activities. Now, if you noticed, on January 4th, David hired a worker for $100 per day to help him in all areas of his business. The worker got paid a sum of $2,800 on January 31st. But David forgot to report this wage expenses in his business's financial statements. So before I give you an assignment, let's recap what we have just learned in this video. We covered the definition and purpose of accounting, then the 4 financial statements including the balance sheet, income statement, statement of cash flows, and the statement of changes in owner's equity. We moved on and explained the 5 major accounts. Then we covered the separate entity concept, and we quickly explained the accounting equation. We also used the story of David Burgers to demonstrate the preparation of financial statements. This was just an introduction to basics of accounting. I will add more videos on various accounting topics in the upcoming weeks. So if you want to improve your accounting skills, hit the subscribe button. Also, hit the bell icon to be notified whenever I release a new video. Those things are free, but it really helps the channel. Alright, here is your assignment. Since the payment of $2,800 affects cash in bank and wages expenses, all 4 financial statements need to be updated. So, prepare a set of updated financial statements for David Burgers for the month of January from the following accounts. In the comment section of this video, let me know your final figure for net income, ending owner's equity balance, total assets, and total liabilities plus equity. Also, if you have any other questions, let me know. I will review your answers and respond to you as soon as I can. I hope you found this video helpful in understanding the basics of accounting. Thank you so much for watching. You may watch this video next. Otherwise, I will see you hopefully in another video. Bye bye and take care.